Welcome to Upleveling, the podcast dedicated to building better leaders, smarter systems, and bigger results. Welcome back. So, if you didn't notice, I have been on a little summer hiatus, and now we are ready to start season 2 of the Upleveling podcast. We've got lots of good ideas and episodes planned out, but I'm always anxious to hear from you guys and see, like, what do you want to hear more about? What is the most interesting we could discuss, and how can I help? So that's really what the podcast is aimed to do, is to help you in your business, help you with your mindset, your strategy, your systems. And like I said, I'd love to know what your thoughts are and anything we haven't covered. But let's hop into it, and we're going to get right to the episode. I bought your business this morning, and I haven't met your team yet. I have had your financials for about 4 hours, and here is what I already know is wrong. Here's the promise I'm going to make to you. There's 3 moves in this order in the first 30 days. That's not 7 things, it's 3, because you can only fix what you can hold in your head. And if you make that list way too long, you won't accomplish any of them. So I'm breaking this episode up into 2 parts, where part 1, we're talking all about the money. And then part 2, we're going to talk all about time and demand. So if I bought your business, this is exactly what I would do. I'm going to go straight to your gross profit margin. The first document I open isn't the bottom line on the P&L. It's actually the top third. Here's what I'm going to look for. I'm going to look for a 3-year trend, not a specific number, but a percentage. A 42% margin that used to be 51% is a business that's declining and not growing. My job is to figure out what's the decrease from. It's either that your costs have increased, but your revenue hasn't, or your revenue's decreased while your costs have stayed the same or went up. That is the fun part about gross profit margin. It is only affected by 2 different numbers: revenue, cost of goods sold. And if you're a service-based business, think of your cost of goods sold as your labor. I'm going to get into that in just a second, but those are the 2 numbers we're going to look at to improve your bottom line. And this, I think, is the area that a lot of business owners skip over, because they mainly are looking at revenue and net income. What you need to do is look at what's in the middle. The issue that I see most owners make and what they're missing is most owners can tell me what their revenue is and what their bank balance is, but nothing in between. I want you to remember, revenue is vanity, it is ego, and it cannot pay your bills. If you cared more about profit margin than revenue, you would make more money. So here's the specific things that I would find in most books. Your cost of goods sold and your overhead are mixed together, so the margin is really meaningless. This is a result of bad financials. The second one is your direct labor is probably sitting in payroll expense instead of cost of goods. So if you don't have a cost of goods section at all on your profit and loss when you're looking at it, you really should. Even if you run a service-based business, I know by definition a cost of goods sold is what is the cost of the good you're selling. But if you are a service provider, I want you to think of this as labor, because that's technically what you're selling. So we don't want all of your payroll expenses just blended with your overhead. We want all of your direct labor in the cost of goods section. For us at Align CPA, our cost of goods section is going to be our production labor. So that's all salaries from the team that's actually doing the work, and then the team that supports them, like admin. It does not include salary for me as an owner who's not in production. So technically, I am still in production. So my salary would be split two ways. One would be to our cost of goods production labor, and the other part would be to our overhead, because that is me as like the CEO role. I also sit in the sales role, so my wages could be allocated to sales as well. But this labor is also going to include all of your payroll tax and your benefits for these employees. The next part of our cost of goods sold as a service provider is our technology cost. So that's the cost of our tax software, our accounting software, and things like that. The software we need to produce the service that we're generating. So my P&L would show revenue, and then it would show cost of labor, and then technology cost, and then that would show me my net gross profit margin. So now you have an idea of what is and isn't included in your margin. So I would look at your financial statements, look at your profit and loss, and make sure it's telling you the right things for your gross profit margin. And that is the number that you should obsess over. Now, here's what I'd do in about a week's time. I would separate out all of the buckets. I would rearrange the financials to make sure it's giving me the data that I want. I would recalculate all of that, and then I would figure out whether we've been profitable or just busy. The next thing I would do in your business is I would pull production by person. So I want to see revenue produced per employee against what the employee cost fully loaded. So that means what is the employee's salary, the payroll taxes, the benefits, all of the things, like what's the full compensation package? So what are they producing versus what they're costing? Here's what I usually would find in this situation. There's going to be a top performer who's carrying like a lot of the load, probably disproportionately. There's going to be one or two people who are underwater, and no one's aware of either one. And honestly, the uncomfortable part is the underwater usually isn't even a people problem. It's a training problem or an assignment problem. But I'd figure out really quickly what it is and how to fix it. Here's the question I would ask each person. What did you redo last week that you shouldn't have had to do? Because rework is invisible margin loss. This is where the money is. And also stop assuming that rework is a people problem. It could very well be a process problem or a training problem. I think by default, we seem to go to the human involved in this and say, oh, they never get it right, or they don't do it consistently, or I always have to get on them because they're not getting it done at all. That most of the time is a process, a system, or a training program. So let's try and fix those. Here's the last thing that changes with your production people is everyone's going to know their number. That's not as a threat, but that's a target that they could actually hit. That number is what's called a metric. This is a KPI. We've talked about KPIs in the past, and I am a big believer that you should have KPIs at the company-wide level and then at each person's level, because people need to know their number and what they're trying to hit. This is what's going to create clear expectations. The team's going to know what their number is, how to hit it, and then we all win. The next thing I'm going to do in your business is I'm going to look and see, when is the last time you raised your prices? If the answer is a couple years ago, I'm going to raise them in month 2. Here's what I want to know. I want to know what happened the last time that you raised them. Did you lose clients? If so, how many? And how many did you lose compared to the ones you didn't? The reason I'm asking these questions is a lot of times we're afraid of raising prices because we think all of our customers are going to leave. And that is usually not the case. So if I can find the data on the last time we raised prices and I can show you, hey, the sky didn't fall and the clients didn't leave, you're going to be more emotionally ready to raise prices. Because I know, and listen, I sit in this same boat sometimes, but as the owner, you're going to remember the one angry email you got from a client that left because you raised prices instead of remembering the 50 who didn't say a word about it. So we want to bring real data to this so you're more comfortable with raising prices. Next, I would look at what the market charges. Most small businesses are priced below their own market and they don't even know because they haven't checked. And then another way to kind of think about prices is if you have more clients coming in the door than you know what to do, that is a sign to raise your prices. You have to think about supply and demand. And when your demand is high, we raise prices. Remembering that pricing is just a lever and it's one that we can pull, but it's also one that most people don't. And here is the bottom line. What is it costing you to skip all of this? An owner who never does an audit of his business and then wants to go and sell it and realizing it's not worth what he wants, or worse, it's not worth what he needs. That is a big problem. So doing these steps are going to help you make more money because the margin trend, the production per person, and the price increases, those are things that are going to make you more profitable. And there are 3 things that you could do this week. Thanks for tuning in to Upleveling. If you found value in today's episode, be sure to subscribe and leave a review. It helps more entrepreneurs like you discover the show. Let's keep the conversation going. Connect with us on social media or visit alignedcpa.com for resources and updates. Until next time, keep leading, optimizing, and upleveling.